We're now having a green municipal finance session. I'd like to invite Mark Huey, if I've got the pronunciation right, my apologies, from Alliance Bernstein, Eric Schrago from the Connecticut Green Bank, Aude Rajanson from the London Stock Exchange, I should say, and joining us online is Patrick McCoy, Deputy Chief Financial Services, New York Metropolitan Transit Authority, who's unfortunately been a bit unwell, but has managed to struggle to a camera so he can join us. Thanks, Pat, for being able to join us. So first, if I can, thank you. Thank you. I'd like to ask Mark to kick off the discussion. Mark is a Vice President Portfolio Manager for Municipal Impact Products at Alliance Bernstein, one of our longest and I'm going to say dearest partners. Have been active in this space for a long time. We'll hear from Aude Rajanson. I'm just going to give you the background, who's global fixed income origination at the London Stock Exchange, and who I would like to tell us about the potential flows of capital between Europe, where this is a huge part of the market, and the US in a minute, and the opportunities for municipal issuance. And then Eric, who's VP of Operations at the Connecticut Green Bank, one of those glorious institutions that I've been tracking for so many years, that's doing so much good work, and is a kind of model, I'm going to say, Eric, you might disagree with me, for the discussions going in Washington, D.C. now about federal institutions that might pursue this area. And I'd love to hear in a minute about what your thinking is about what's going to happen federally. But first, we want to start with the investor voice. So, Mark, you might want to comment on whether I'm lunatic what I just said, but what I really want to hear about is what you see as the appetite and the landscape around greening municipal finance.
Yeah, so thank you for having me. I just want to start off with just the background of what we do at AB for a quick second, right? So the portfolio that I manage is a municipal impact strategy. And the whole purpose of our strategy is to make investments in historically under-resourced and low socioeconomic communities across the country, right? And that is the principal thing that guides all the investments that we're looking to make, right? And one of the things that we're always looking for, as investors, right, is disclosure and just knowing that the issuers are actually putting their money where their mouth is, right? Because it needs to go beyond an issuer simply labeling their debt that they're issuing as green bonds or social bonds, right? As much as we manage billions of dollars over our Alliance Bernstein, it's still, unfortunately, a finite amount of capital that we have. So we need to make sure that every dollar that we're going to invest has a specific purpose and intentionality, right? Because we don't really have a chance to redo this again, right? So some of the investments that we make are in building new school infrastructures across the country, right? And some of the buildings that they're looking to replace are 80 to 100 years old in some cases, right? So initially, right off the bat, if you just build any new building, that's going to automatically be a lot more energy efficient and green, right? But at the same time, when we're talking to issuers, we want to make sure that they are thinking about sustainability, that is at the forefront of their thinking, right? Because as I mentioned, we don't have a chance to build these buildings again, right? And these projects come along, once every couple of generations, and we need to make sure that they're being done in the right way, in the right purpose. So,
and that's a critical point about the nature of ambition, isn't it? We need to make sure we use those opportunities we have to get it right, rather than improve a little bit and then expect to improve a little bit more in 20 years' time. That's a key issue, reason for necessary ambition. Are you getting, what's the nature of success of your dialogue and engagement?
It's hit or miss, right? Because, look, I understand as an issuer, your whole purpose is just to get the capital that you need, get the project done, right? But from an investor such as myself, right, it's my fiduciary responsibility to make sure that our clients' dollars are being put and utilized in the exact way that they're expecting it to, right? And for our strategy being an impact strategy, that's what they expect. So it does take a level of engagement, right? So just to give a quick example, one issuer that I've been talking to over the last couple of months, they're really touting the fact that they're issuing their first sustainable bond, right? It's great. Ooh, congratulations, right? Now, when we're looking through the list of projects that they're making and they're doing, they line up with exactly the type of investments that we want to make, right? Making investments not only in the community, but also in new building structures that are potentially going to be LEED certified, right? But as I talked to the issuer more and I was going through their, their roadshow and their offering statement, it became evident that I'm not sure that the issuer was even thinking about these things, even though they labeled themselves a sustainability bond, right? And some of the tells that I found was that they were going to issue a sustainability report when they finally spent the hundreds of millions of dollars that they were looking to borrow from the market, right? So this is going to take 2, 3, probably upwards of 5 years, right? So as an impact investor, I can't wait 5 years to see how those dollars are being spent, right? I need to know along the way. Not every day, not every month. I'm not that cynical, right? But at the same time, I need to know that at least on an annual basis, that these issuers are tracking their greenhouse gas emissions, right? That these dollars are being targeted towards the communities that need it the most, right? Because when it comes to climate change and issues around environmental justice, we know that communities of color and communities that are historically marginalized, that they are going to be disproportionately impacted by all these environmental issues that are coming, right? So we want to make sure that these issuers are thinking about these things, especially if they're out in the marketplace saying that they're issuing a sustainability bond.
There you go, the demand side. Of course, New York MTA is, I think, the leading muni issuer, green muni issuer in the country. 10 years ago, Pat, I had a conversation with a major investor in London who came up to me afterwards and said, so railways, why are they green? Aren't they dirty? Low carbon transport, etc. That's a cue for you, Pat. Tell us your story.
I do apologize that I'm not there in person. I'm just recovering from a pretty bad cold, and I didn't want to risk spreading germs around the group there. But I'm really excited to be able to talk about being a green bond issuer. It's a journey that we began in late 2015. The governor of New York at the time asked a similar question. You guys issue a lot of bonds, you're public transportation, why aren't you green? And so we spent a fair amount of time and worked with a lot of our advisors and consultants to figure out what's the best way to do this, and really a gating question, should we do it? And what we quickly realized is, we should be doing this because the things that we do to move people around the New York metropolitan region are inherently green. We move people around predominantly on electrified rail. We run the largest transit system in North America pre-pandemic. Between our transit system and our commuter rail system, we were moving over 8 million people a day. Now, of course, the pandemic has had an impact on ridership as it has across the world with public transportation entities across the world. But we're still moving about, in some cases, 70–80% of pre-pandemic riders. It varies by day and by weekend, et cetera. But we continue to run 24/7 service because it is what this region needs. We are a dense urban region that is only possible because of the public transportation that the MTA provides. So back to 2015, when that question came across, we really rolled up our sleeves and worked and determined that the challenge for us is that we are a large issuer. The MTA currently has about $50 billion in debt outstanding, all of it for capital over the years that we've issued, and we're going to continue to be a large issuer going forward. That said, how do we fit into a program in a way that's manageable for the issuer side? And that's one of the themes you'll hear from the issuer community is, it's too complicated, too onerous. We're not ready to do that. And I'm here to tell you that as a big, complex, complicated issuer, we found a way, and will continue to be a significant green bond issuer going forward. We settled on CBI at the time with the low carbon transport criteria that has now evolved, continued, and will continue to evolve. I'm sure, Sean, you can speak to that. But because of our programmatic nature, I have to say, being able to work with the CBI team to figure out a way to meet the requirements of the program, to satisfy the investors like AllianceBernstein that who have that fiduciary obligation. We take that seriously as well as an issuer. We want to make sure that if you're putting our bonds in a particular bucket, that you can support that decision, that investment. So We issue programmatic bonds under the criteria. We currently have over 12 billion outstanding, but we've recently gone through an analysis of our most recent capital program, and we look back at capital program because a capital program in our world is a 5-year program. The goal is not to spend every dollar in that 5-year window because many of these projects take years to deliver. So those cash flows extend on for several years beyond that 5-year window. So our most recent capital program that was reviewed and analyzed by an independent verification agent determined that we have an additional 28.7 billion of issuance under the CBI criteria that we can do. So you'll continue to see MTA be an active issuer as a green bond in the green bond space. Why don't I pause there and see if there's any other comments or questions, Sean?
Was the governor happy?
I think
I would ask the governor's changed, but nevertheless, it's interesting. We need to ensure the story goes back to our political leaders as part of the whole story. And of course, you've set off a bunch of other green issuance in New York, like New York State Housing and so on. One of your companion issuers, I'm going to say, although they're a little bit after New York, was Connecticut Green Bank, a different kind of approach. And Eric, the Green Bank was set up for a purpose to deal with energy efficiency and renewable energy. And then on the back of the loan portfolio you created, you've started issuing green bonds. Can you tell us how that's gone and how you've been working at Connecticut?
Certainly. So it started out of necessity, and I'll pause to say the first thing that I was told when I was told to go figure out how we labeled this was go do what the MTA did. So, so thanks, Patrick. But going back to 2017, 2018, our cash reserves got swept by our legislature. We needed to figure out a way to recapitalize ourselves. We looked at our businesses. We did a bunch of strategic rethinking. We said, look, we designed our solar program to have some long-term cash flows going through this. Let's go out and securitize them. So we took the first REC-based transaction to the market. We went out to the asset-backed markets, which at the time made sense due to the complexity and where markets were, and issued the solar REC-backed bond. And due to the continuing nature of our solar incentive program, we were able to go back to the market and issue a couple more bonds, all of which have been CBI certified, and we've become a programmatic issuer. The second 2 bonds we issued in the muni space, just due to cost, the market had evolved and it became a lot more cost effective to go that route. And I would say that we'll come back to that market probably one more time, just as our solar program has hit its target and we still have some assets that we want to securitize. But we didn't stop there. One of the things that came to us, kind of looking back to the whole process of our legislature sweeping our funds, was green bonds weren't just a tool to recapitalize ourselves. Could be a tool that could be more engaging for the public, that when looking at the transition to the green economy, this isn't really just about getting people to put solar on their roofs or put in more insulation. We want people to be able to be a part of the entire green economy. So we wanted regular people to be able to invest. So with the second 2 mini transactions, we worked with our bankers and with DTC to get the minimums down to the minimum par amount to $1,000 with DTC, which when you're talking to your ordinary Joe, getting them to make a $1,000 investment, that's not going to really fly for everybody, but we did see a lot of traction from a retail perspective on our last issuance. We were oversubscribed to the point that it drove down the interest rate on our institutional day.
Yes.
So we did get a little bit of a premium there. And we're tracking these investors, we're engaging with them, and we're doing our best to get as many of them from Connecticut as possible. But we took this even further. And we went to crowdfunding markets. Due to the $1,000 minimum depository trust, that kind of left us hamstrung. So we said, what can we do in the crowdfunding space? And out of the School of Management and School of Forestry. I think it's now the School of Environmental Studies, but at Yale started a platform called Raise Green, and we've partnered with them over the past year to do, I think we've done 4 issuances so far of what we're calling our Green Liberty Notes, which are basically short-term, 1-year duration securities that people can invest as low as $250 in. So we're seeing a lot of uptake from residents in Connecticut, residents across the country. And so we're going to look to continue to expand that. But just talking about green investing as a whole, I mean, Sean, you quoted the number of $9 trillion a year. I think my numbers are certainly out of date for that, but we're looking at the state of Connecticut, and to do our part to whatever the $9 trillion number was at the time, we really needed to go from a factor of $80 a year of investment is what we had on a per capita basis of Connecticut residents. We started with $8. We're now up to 80. We need to be at 800 a year. And so how do we scale that? And we really view the green bonds and ordinary people buying those as the way to do that. That we have called our issuances Green Liberty Notes and Green Liberty Bonds as a reference back to the World War II effort, where we really saw the nation come together in a large-scale mobilization of capital like this. And that's certainly what we view as needed at this time.
So enthusiasm from a retail audience as well as the institutional audience.
Yes.
The first green bond in the US was issued by Massachusetts, as you'll remember. And I Pilson was speaking to the deputy treasurer a week afterwards. He said, Sean, in 20 years working in Treasury, I've never had this many phone calls. It's so cool. People phoning me up saying how fantastic it was. Treasurers, Eric, I think, are not, fair to say, are not used to getting sort of excited phone calls from the general public. Do you get a bit of that still after all these years?
Yes, we're still working through how we liaise with the public on this. So we've set up some portals, we have some tools, but we certainly have been engaged more than I think we were prepared to be initially. But it's a good thing.
Pat, just a question. You've got a retail program too, haven't you? Retail.
And that's run by my colleague Marcia Tani, and Marcia is just an outstanding individual in communicating with investors and keeping in touch and making sure that they have the information they need. As a green bond issuer, we do appreciate that investors want to know what we're doing, they want to understand, and we're continuing, our disclosure is continuing to evolve and bring in more information because, Sean, as you so eloquently pointed out, the challenge is before us now, and we have to show the path how we're going to get to these goals. We have our own very ambitious goals. One of the things I didn't talk about earlier is the fact that our entire bus fleet of about 5,800 buses, we've made a commitment to try to electrify that entire fleet by 2040.
Yes.
So that's going to be a difficult process, not because we don't have the will, but because the industry is still catching up and hopefully building up to meet not only our demand, but demands of other public transportation entities that are going to want electrified buses. That is the one piece of our program, having diesel buses on the street, that we're laser focused on making that transformation to electrification. The other technology that we're also exploring is renewable natural gas, natural gas from waste facilities, et cetera, where you can actually achieve negative emissions. Now, we plan our whole green bond sort of premise on the fact that by providing public transportation, we offer transit avoided carbon. We estimate that on an annual basis, we're avoiding 17 million metric tons of greenhouse gases going into the atmosphere just by the very nature of what we do. And getting recognition for that in the marketplace from rating agencies, from investors and other market participants is really has been very satisfying and very rewarding in helping build that momentum internally to focus on things like buses and other enhancements that we can do to be.
So the role of public procurement in driving change, getting those electric bus manufacturers up to speed, quite important. The retail role, I just want to make a comment on that. We don't expect capital in scale to come from the retail sector. That would be a foolish view. It's going to come from institutional investors, clients at the end of the day. However, there's a real lesson learned between Denmark and England around engagement. When it came to onshore wind, the Danish made a decision to ensure a little bit of money and opportunities to invest always went to a local community. And some solar developers have followed this through by issuing retail green bonds in communities where they're building large-scale solar plants, etc. The British didn't do this. As a result, the British have had a continual fight for 15 years to get local communities to accept onshore wind and to support it, a lot of resistance, whereas the Danes, local communities everywhere are organised in the building of them. This is how retail can work. It's an engagement strategy, and it's also, for those of you that are political decision makers, an important part of political engagement too. Giving people a sense of participation can be incredibly important to making sure more of what needs to happen can happen in the future. I'm not commenting on the treasury requirements of Canadian Green Bank and New York MTA. It's a separate issue, but just I'll put that out there. But I want to just segue now forward to London Stock Exchange cross-Atlantic capital flows. This conversation started with San Francisco Public Utilities Corporation, talking about listing on the London Stock Exchange to give access to their bonds to European investors. Is this real? Can you tell us a bit more?
It is.
So how does it work and why?
It's a good question. Yes, so obviously the role of an exchange is to facilitate the flow of capital between those who have it, so investors, and those who need it, issuers, on a global scene. One of the differences that we see between domestic market in the US and the rest of the world is that bonds that get issued in international markets tend to be listed because it's a requirement from investors, especially in Europe, who are limited in terms of the capital that they can invest in, that it's not listed. And so the London Stock Exchange set up its own sustainable bond market a few years back. We were actually the first exchange to do so back in 2015. And so we launched a green bond segment that then got expanded to social, sustainable, sustainability, linked bond, and transition segment as well. And we've seen since then, obviously, that's the good news, a great increase in capital. And we've seen issuers, landmark transactions all the way from Korea to Benin in Africa to the UK government to San Francisco Public Utilities Commission, which issues its first green bond that was listed on our exchange. And what we've seen is obviously the volumes on our market are driven primarily by public sectors, right? So government, SSAs, essentially government, and multilateral development banks and local authorities. That accounts for about 50% of the volumes that we see. And it's primarily green bond issuances. Even though we start to see an increase in other structures, such as sustainability-linked bonds. What's interesting from a sort of a market perspective is that, this year, obviously, we've noticed that the volumes of fixed income issuances have been down because of the macroeconomic. We've seen obviously the war in Ukraine, but also interest rates are on the rise everywhere. That have impacted the market. However, from a sustainability point of view, our sustainability bond market has been quite resilient. And we've seen some very interesting transactions coming to market and being quite successful. We've seen, for example, the Saudi Arabia Wealth Fund that issued a century bond, a century green bond. So it's 100-year, and over $3 billion. And the order book for this was about $24 billion. So quite successful. We've seen recently the government of Uruguay issued their debut sustainability-linked bond, and they've actually sort of issued it with innovative structures that had a coupon step down if they managed to meet certain targets over time. So what's interesting there is that it shows that it's almost like the fact that there's a label green bond, that there's a label sustainability means that it has been really helpful for issuers accessing the market. And it has enabled issuers to actually being able to issue in this very volatile market. And to Pat's point earlier, I think what we have noticed with these issuers who were able to get away with a successful transaction is because they have had a very sort of transparent and ongoing dialogue with investors throughout. So whether it's a like non-deal roadshow or promoting a framework, there's always been that sort of dialogue before they issue to make sure they bring as transparency as possible. They address any questions beforehand with investors before launching the transactions.
So it is real.
It is real.
And I imagine at coffee break you're going to have a pitch to Eric and to Pat online about how they should consider this going forward. I hope so, because we want more happening, but we'll leave that going. US names, though, in terms of actual listings, I wasn't clear. What success have you had so far on US organisations, entities in the muni space taking advantage of this, apart from San Francisco Public Utilities Corporation? Give us a little teaser of what's out there in terms of coming deals. Anything? And she's probably not allowed to tell me anything, right? But
Well, yeah. No, I think the San Francisco Public Utilities Commission was a very successful deal. I think what was interesting for them, the reason why they, the team, and they really did a fantastic, work, and it was actually certified by CBI, right? But the reason why they wanted to do these transactions was a few reasons. The first one was obviously a lot of it was actually profile raising, right? And being seen as a leader on a global scene as a muni to demonstrate their action towards climate change. But also they felt like it was important for them to also tap into a pool of investors that it's very focused on ESG, right? And when it comes to the pool of capital and the interest from the demand, really is in Europe, right? It's fair to say that Europe is a far more advanced market when it comes to sustainability than the rest, than the US probably. And so it was really important for them to be able to access that investor base, and hence why the reason why they listed on the London Stock Exchange. And I think overall as well, it's always a taxpayer money. And what's interesting is that they actually did manage to see a premium of about 3 to 5 basis points. So,
nice.
Yeah.
Okay. I mean, interest rates in general, the euros are still lower than USD quite substantially. So I'm hoping there's an arbitrage opportunity, but I appreciate any evidence is not there yet. But, it's worth exploring that opportunity. The interesting thing is the extent to which demand has begun to rise in the conversations we're having with European investors, largely because the muni market is remarkably low risk. I mean, despite, Orange County, it still hangs over us from all those years ago, was it 15 years ago of default, whatever it was. Actually, the default rate in munis is remarkably low compared to corporates and so on, which is a very attractive prospect for investors around the world. So there's a story there, I think, is the key thing. But look, our theme today is how do we massively scale it up? Of course, broadening access to investors for issuers, getting many more, so when you do scale up, you can place faster, is one aspect of it. That's how that fits in it. There are other things we've got to do too. And Mark, I want to go to you, but I want to signal to everyone, I'm going to take a round of questions in a couple of minutes. And I'd like to get 4 or 5 questions in a row. Everyone gets 30 seconds. Be prepared. I'll call a couple of you out if necessary. So be really prepared. Mark, how do we grow this? Now, I'm curious from your client perspective where this is going. In other words, have you got so much demand you don't care about the buy side, it's all about the deal flow? Or are the buy side things to do? In your conversation with the pipeline, what do you think needs to be done?
It's something that I kind of go back and forth on when I'm talking to issuers and other people in the asset management industry. But I do feel that the buy side is really going to be driving a lot of this in terms of demand, right? Because some of the issuers that I've spoken to on other conferences, even one-on-one, one of the things that they're always looking for is, well, give me a reason to issue these green bonds, right? Not just the purpose behind it, but also just give me a reason why, right? And it's great to hear success stories, like SF Puck, where they're able to see those greenings, right? But for issuers that are not used to doing the level of disclosure that we're looking for, where, truth be told, some of these issuers that we're dealing with, these municipalities, they're probably already underfunded on their side of the business, right? That means you just have a skeleton crew of people working in the finance department or treasury department, what mind you. So those are some of the structural challenges that we're up against. But if we are able to show these issuers that there's a lot of demand out there, that I think will drive a lot of the issuance that we're looking for, right? But for us, once again, as impact investors, it always just gets back to, if you're willing to do this, if you're putting the issuance out there, you need to show us exactly where these dollars are going, right, and how you're planning to spend it, right? And that's really what makes munis a very, kind of unique asset class, right? Is because of this use of proceeds model that municipal bonds have, right? If you're going to issue debt, you need to lay it out and tell not just myself, but you need to tell your citizens, the people in your community, exactly how those dollars are going to be spent, right? And for us as impact investors, we need to see that so we can show that to our clients.
This is the difference between, say, US sovereign infrastructure bonds versus T-bills for general operations, really. More of the infrastructure, less of the T-bills, kind of what you're saying, right?
Yeah.
At the end of the day, we don't really care about the thematic label, do we? Like, we just care the money goes to the right place. We just care that the investment's being made. What's the benefit of the thematic label from your perspective? How does this work?
Honestly, I mean, as an impact investor, right, I keep going back to this, but the labels don't matter at the end of the day for us, right? What matters is exactly how the issuer is laying out, how they're planning to use those dollars, right? But not just telling me how they're planning to use it. I need to be able to see it as well, right? There's that level of accountability, there's that level of transparency that I need to see as an investor in order for me to go forward, right? That's why whenever I see that, an issuer has gone out and got the CBI designation, that's great for me because, not just because an organization like CBI is standing behind the issuer, but I know that there's also additional data that I'm going to be able to get out of the reports that are very just pertinent for investors like myself.
So it's like a due diligence proxy is what you're saying us.
Yes.
I'm glad you said that because I've got Nicholas Butt from the International Capital Markets Association later. I need to make sure he thinks it's all good and we're okay. We're not trying to cut across it, so I appreciate it. Pat, anything more you want to add about the difficulty bit? I mean, Mark has essentially said there are barriers with issuers saying it's hard work and they haven't got the capacity. What do you want to say to your peers around the US?
Sure. Yeah. I think that's an issue that we all need to work to overcome. I agree that the buy side is going to be a very important player in terms of helping to motivate and encourage the issuer community to think about their investments in infrastructure. When you think about core infrastructure that that American cities and counties and states rely on, is the building block of our society, whether it's public transportation, hospitals, schools. We need to be thinking about how we're making those investments. What are we doing? Why are we making the investments? And just a little more backdrop in terms of our getting into the green space. For those of you who are familiar with New York, in 2012, we were hit by a devastating storm surge that flooded us in very severe ways. Lower Manhattan was shut down for several days after this storm. A lot of our assets were flooded, subway stations, tunnels. What we realized is that the next storm that hits us can't hit us as hard because we have to make those resiliency investments so that we're better prepared. And that story can be told 100 times over across the country. In fact, thousands of times over. As issuers think about making these investments, many of them need to appreciate that what they're doing is green, assuming there's resiliency built in and so forth. And so my my commentary to my fellow issuer community is that it is very doable. It is not outside of the realm of costs. It is not cost prohibitive. I think I appreciate that our stakeholders here at the MTA didn't come to me and say, well, how much are we going to save by doing this? My response to that is to the degree that being a green bond issuer brings that additional investor or two to the table demanding bonds, I've achieved my goal because I'm bringing people to the table that might not otherwise be there. And Sean, your comment about bringing retail in, I think, is very important as well. Whenever we issue a long-term bond on a negotiated basis, we devote an entire day typically to a full retail order period where only true retail investors can access and buy the bonds. And that's something we've had in place for years, even prior to being a green bond issuer. And so what we're seeing with each issuance is more participation from the retail community. Granted, markets come and go, and in some markets we have less participation than others, but by and large, the trajectory is that people do care and they do take an interest. And from an issuer perspective, I have to say, look, the CBI folks, the verifiers, they have been very helpful working with us to meet the requirements, and then to think about future disclosure, which we want to continue to evolve to better tell our story, better tell the story of why an investment in core infrastructure and public transportation in New York is a good investment, because we're doing it with a mind to the future, not just what maybe might have been planned 10 or 20 years ago.
Eric, did you want to come in?
Just to build on that and get into the point that you mentioned earlier about what's happening federally, I mean, this is a great way to spark additional issuance. So I'm sure as many of you know, in the Inflation Reduction Act, there was earmarked the Greenhouse Gas Reduction Fund, which was two pots of money, one about $20 billion, the other about $7 billion. With some other carve-outs in there for targeted to low-income communities and disadvantaged populations. But the intent of the $20 billion was to create a national green bank, the National Climate Bank, which will hopefully expand access to low-cost capital, really focused on the community and spurring other institutions. And as being a part of a group that's working on the implementation of that, we've really looked at secondary markets as a way to further this. With it, we realized that the initial seed capital is kind of I would say something beyond a generational opportunity. And so we want to make that last and go as far as we can.
So what you're telling me is we can expect green bond issuance out of a federal institution? Yes! And that, of course, is the secret, that we need to use our existing capital base to do much more.
Yes.
It's not enough just to have funds and expend it. We've got to actually leverage and provide opportunities for investors to participate through this process.
Absolutely.
So look forward to that. I want to just take a few questions, see if there are any comments or questions in the audience. Do I have any hands up? We've got some microphones, right? Emily Wing from BlackRock and the gentleman in the green tie. Run with the microphone. Brian, over here. Emily, put your hand up. And Neil, come forward. Chap in the green tie here, put your hand up, please, to get the microphone. Emily, go ahead.
Hi, question for Patrick and Eric on greenium, since you also target the retail investor base. Do you see a greenium difference between the retail versus the institutional investor base? That's number one. And number two, how do you see yourselves taking advantage of the IRA?
Stand up. Question. We'll take a few at a time, then you think the answer.
Yeah, mine's just to piggyback off
Just
that
tell
question.
us who you are. Sorry, my apologies.
Oh, Adam Phillips. I just want to piggyback off the Inflation Reduction Act. In the Green Bank Coalition that was outlined, that you're part of, specifically the Connecticut Green Bank and the MTA, there was a discussion about private equity teaming up with sort of a PPP approach on top of leverage. Is that going to be the strategy going forward?
Good question. Any more? A couple more questions. One here in the front. Put your hand up in the back if you've got a question. There'll be one over here as well. Neil, on this side. Please go ahead.
Hi, Mark Ted Cromwell with Smarter. So my question is, if you as a bank had a risk-weighted adjusted asset for green assets, do you think that would stimulate lending if that was adjusted for credit market and other, based on climate risk reduction?
Question just here.
Thanks. This is Eric Pitt. I'm with Ceres. And I've heard a lot of discussion about issuance within the climate bond initiative. While I don't know the details, I take it from what I've heard that there's a component of issuing under that program that involves heightened disclosures relative to what might otherwise be required. We spend a lot of time thinking about issuer disclosure in the markets. And we've spent a lot of time advocating with federal regulators, for example, the SEC and corporate issuance and the disclosure rules that are on the table there. We are of the view that the U.S. municipal market is in very significant need of a regulatory overhaul around disclosure, and that the significant carbon footprint of the municipal infrastructure in this country, and then the retail ownership of municipal bonds, and the long-term nature of those investors, often in their retirement accounts, all of that argues that there should be more mandatory disclosure from municipal issuers. And so I guess my question, given that all of you are probably on board with that disclosure idea, is, what should people do who want to, what's the path forward to requiring more mandatory disclosure, to raising awareness of this issue? The MSRB does not seem to have focused on this.
Thank you. Any last questions? Pick a question.
I'll see how many I can answer with one answer. So to your question on greenium, yeah, we saw a greenium with the retail investors versus the institutional, and we reduced interest rates that we were going to pay for certain durations on our issuance. I'm trying to remember exactly how much it was, but I don't remember the numbers off the top of my head.
Is there a difference? Retail and institutional?
So we always do similar to what MTA does of a retail day followed by an institutional day to kind of close the gaps for where there weren't retail subscriptions. So the retail kind of institutional setting the rate effectively because they're closing the gap, except where there isn't a gap. So yeah, there are differences. To the questions in the Greenhouse Gas Reduction Fund and the Inflation Reduction Act. So what I'm excited by that's in there is there's a whole host of incentives that, it's a whole maze of things that need to be dissected and digested. And I'm excited because I think that's going to spur a lot of investment. Kind of beyond that, I just came from a climate tech partner in Soho who's doing a lot of stuff in the EV space, and they really see this as, hey, we have a lot of, by getting people into the EVs, this is getting people interested in whole home electrification, going solar. And so I kind of think that there's a lot more of that that's going to be had and it's going to be sparked by the activities for which there's incentive there. To the question on private equity and leverage, Connecticut Green Bank's model and the overall Green Bank model is built on leverage, that we use as limited as possible public funding to attract private investment. That's been the secret to our success. And on a federal level, on a national climate bank, and the model that we have been discussing, that's core to it as well. So in terms of public-private partnerships, it's going to be the MO going forward. So I'm hoping that the EPA buys into that as well and recognizes that that's the way that you stretch these dollars.
Pat, do you want to comment, particularly on the greenium?
Sure. On the greenium, great question and something I've been asked a lot. I would say no. When we put the retail investors in competition with the institutional investors for the same bonds, what we find is the retail investors are less sticky than the institutional investors as we reprice down the curve. And so that's, and again, just to reemphasize the point, we're not seeking, definitive analytical proof that we've saved a basis point by being a green bond issuer. That's ultimately a goal we'd like to get to, but that's not where we are at the moment. We intentionally make sure that we're getting the best cost of money, the lowest cost of money, by actively engaging with the segments of the market that are interested in our bonds, by putting that green CBI label on our prospectus. We believe and we know that we do bring other investors to the table that might otherwise pass that issue by. The interesting thing about our market is there's about roughly 50 to 55,000 issuers across the United States. So the investment community has a lot of work to do to sort through that big mass of issuers to find those that they feel comfortable investing in. And I'm going to skip to the fourth question, if I could, about disclosure. I am not of the mind that the state and local government community, the municipal issuer community, is in need of disclosure overhaul imposed from above by the MSRB or Congress or whoever. I don't think that's the answer. Our market is unique because of the needs of the market, not because it's been intentionally created that way. We have to remember that state and local governments do have sovereignty, and having the federal government or impose disclosure standards, I do not believe that that's the answer, because a one-size-fits-all standard is not going to work for this very balkanized market with thousands of different issuers. I will say that I am a big fan of robust, strong, and frequent disclosure, but I would not want to deal with an imposition of changes to that by an MSRB type entity. On the P3, we're just beginning our work in the P3 world. Our board just authorized a very significant P3 project that we'll be embarking on next year. And this is to improve accessibility, ADA accessibility to the subway system. We have over 472 stations, and about 180 are currently ADA accessible. So we've got to invest billions of dollars in elevators and new elevators in a very old system that was designed without that technology. So we've partnered with the private sector to come in, and we're going to see how this goes. But we believe we've got a motivated private entity that will be at the table in helping develop and build these assets that we need for the public. And we're exploring other ways to get the private sector involved in the MTA's capital program. We're currently working on a 5-year capital program that is over $55 billion. So P3 will be part of our project delivery approach going forward. And this project will be an important, marker for how it works and what about it we've done right and where we need to improve it going forward. But we think that's a very critical project delivery approach that we need to take, and I've been very happy to be involved in that. I think that's kind of the core questions. Was there more that you wanted me to address, Sean?
And Pat, I'm curious about the program of the capital investment. I mean, apart from coming off the subway this morning and realising the places without any kind of accessible access. So I'm so pleased to hear that. But of course, you've got this thicket of different organisations. And I remember you telling me the Moynihan Hall story. And I think it's Empire State owns the tracks, and New York MTA owns other parts. And the challenge of trying to reconcile different interests of different organisations to deliver services for New Yorkers. So there's a public sector organisation job that's going to be required, presumably for your CapEx plan. Is that right? Have I got that right?
The MTA and other entities like us, we operate in a complex political environment. We work with the city of New York, the state of New York, the federal government, and then the 12 counties that we serve. So that's always going to be a dynamic that we have to contend with. Moynihan Train Hall is a really wonderful project that we were involved with Empire State Development to bring that to fruition, and it's really the beginning of a complete transformation of Penn that has been widely talked about by the governor and chair of the MTA and the mayor and other folks. It is essential to think about Penn and to think about making it better. We know it's not the greatest station from a sort of an infrastructure perspective, and it's constrained and doesn't meet the needs of the modern day New York. But we've already begun these massive investments, Moynihan, but the main corridor of Penn has been completely improved, and the ceiling raised and so forth. There's more light, but you'll see investments in Penn for the next several decades as our stakeholders work together to figure out how to do that.
Well, that's good news for us railway travellers anyway. Look, we need to wrap up the panel. So I'm sort of after some final comments on how we grow this. Ord, I actually want to start with you, because there's a different kind of arbitrage that you're involved in, which is the arbitrage between the extraordinary demand for thematic instruments and green, and of course all sorts of other measures like transition requirements by the UK government so in Europe. And I'm going to say the US market that's grappling with this, while we've got some great fund managers and asset owners pushing the envelope, we're still getting there, right? What's the US got to learn and got to gain from this transatlantic conversation and opportunity of LEC? Give us a bit of a flavour, and how you can help us get to $5 trillion a year.
I mean, I think my perspective on it is I think it's there's a lot of when we look at the muni market globally, right? There's a lot. In Europe, the muni market is very developed when it comes to green bonds, but also in Asia. And I think it's important that the US maybe open up a bit more and look at what's being done and the success stories that has been done by other similar issuers across Europe. The cities, the city of Malmö, for example, issues regularly on the market, and look at these transactions and how they're being executed, and also just maybe consider other sort of, like I was saying earlier, the fact that a listing is not a requirement in the US because it's a very domestic market, but actually it opens up the door for access to a global investor base. In our market, we have access to like 6,500 institutional investors. That's a lot. And so that's important to be maybe looking at that when insurers look at structures.
And your green bond listing on LSE is the biggest in the world, isn't it?
Sorry?
Your green bond listings on the London Stock Exchange, that is green instruments. If I remember correctly, it's the biggest collection in the world, isn't it?
Yeah, we have it's the leading one. We have about $180 billion worth of capital outstanding.
Cool. Mark, how are we going to do this? Just give us the 3-point formula so we can all go home.
I mean, for us, it's really about, making every dollar count, right? And, like I mentioned earlier, these historically under-resourced communities that we're solely focused on investing in, they're going to be disproportionately affected by climate change and all these environmental issues that we're here talking about, right? So if we really want to push the needle, we need to realize that that's where we can really make, get the most bang for our buck, right? Because I've had, potential clients come through the door and, they'll tell me, look, we're only just focused on the environment. Social issues, that's secondary, tertiary to us, right? But for us as impact investors at AllianceBernstein, for us, all these issues, they all come together, right? We often hear issues around environmental justice. We often hear around, communities like Flint, Michigan, Newark, New Jersey, when it comes to their water issues, right? When we think about peaker plants, I think the statistic I came across was something like 40% of all peaker plants are located in communities of color in California, right? So if we're thinking about how we can make this transition to a more green environment or a more green infrastructure, we need to be thinking about these communities that are going to be disproportionately affected. So,
fantastic. Eric, parting reflections.
Well, Mark just took the point that I was going to make. But our thinking is this is going to be a trickle up, and we really have to focus on these communities without historic access to capital, without historic access to what's new, what's trendy, what's the latest technology, and figuring out how do we enable them to come up the curve as quickly as possible, because the more that we can accelerate them, they're actually going to bring everybody else with it. That we can, if we facilitate them, we're going to create that momentum that's really going to create that change.
Fantastic. And Pat, as I muse on the prospect of superfast trains all around the East Coast, Senator Moynihan Hall, and the future infrastructure investment it's going to require, your parting reflections on this green muni market.
Sure. Thanks, Sean. Well, look, I really want to give credit to CBI for really being a leader in this area. I think look, we can learn a lot from each other, and I'm a big fan of collaboration, and believe that that's the future here. And I think optimism about the future. We need to be optimistic that we can make a difference. And as an issuer that's been in this space for a long time, I'm optimistic that other issuers will continue to grow. We'll continue to see more in this space, because the buy side is going to demand more, and that's really where it comes down to is the buyers there, and articulating your needs, your desires, your wishes to the issuer community is very important. That's what moves the needle, and so don't be shy. Pick up the phone, send an email, let them know what you're thinking and why you're making the investment decisions you are, because that will drive the disclosures that you want and need and deserve to make these investment decisions, rather than having those imposed. So thanks for letting me participate today. It's really appreciate the opportunity.
Thank you, Pat. Thank you, Eric. Thank you, Mark. Thank you, Ord. Please give them a clap for them. We've got a short break now. This is the networking opportunity. Please mob Eric, Ord, and Mark in the break. And remember, the goal of this is to look at how we grow to 5 trillion. Growing to 5 trillion will require deals. That means if you're an investor or an issuer or a consultant, we need you to be talking about actual investments. So that's what the break's for, everyone. Come back and report afterwards of new deals. Thank you.